And thank you again for joining us today. I personally am so excited for this next panel. Some of my absolute favorite people in this industry who have a lot to say. And I just want to give you a little bit of context before we start a discussion. So I'm Rachel McIntosh. I'm going to be moderating this discussion. I am a journalist, a podcast I'm a journalist and a podcast host who's worked in this industry for several years. And what we're going to talk about today is the intersection of three different things: human need, innovation, and regulation. So we all know that this session is about crypto. And innovation is very often driven by human need, and in fact, innovation meets needs that governments and regulators often don't. However, there's this ongoing dance in between innovation and regulation. One is always lagging behind the other. You can guess which one. And so here we have these experts here to talk today. I'll let them introduce themselves in a moment to cover a wide range of subjects. So I'm really excited to see where this goes. Thank you for joining us. Okay, microphones. Yeah. Can we give a round of applause? And let's just start at this end of the row and then come down. Could you all introduce yourselves in about 30 seconds or less?
Sure. My name is Dickie. I'm head of EMEA sales at B2C2. We're the world's largest crypto liquidity provider globally. As well as on-exchange market making, we price as principal to over 500 institutional clients in 53 countries.
Hello, everybody. My name's Ian Taylor. I'm the Executive Director of CryptoUK. We're the UK's trade body advocating for fair, balanced and proportionate regulation.
Hello, everybody. My name is Ziv Keinan. I'm the CEO of Symmetria and a former crypto and blockchain lawyer. My company Symmetria is the first approved digital securities trading platform out of Israel. In February this year, we received an approval letter from the Israeli Securities Authority.
Hello, everyone. My name is Michael Pearl. I'm the COO of Kirobo. I'm happy to be here. Kirobo is a blockchain technology company that works in the realms of DeFi, decentralized finance. We're mostly known for the undo button, allowing people to retrieve crypto transactions, and I'll talk about it a little bit later.
And I'm Teana Baker-Taylor. I'm the Chief Policy Officer at the Chamber of Digital Commerce based in Washington, D.C. We also are an industry association advocating for balanced regulation. And we also work with policymakers in the U.S.
Thank you all. So as you can see, we have a very wide range of expertise here on the stage. So what I'd like to ask you all first is, we'll do a little lightning round, if you will. So coming from each of your unique perspectives, thinking about the last year, perhaps 2 years in crypto, I'd like you to pick two things actually. One thing that you think has changed for the positive, and one thing or trend that you think is sort of going maybe in not so positive direction. So again, we'll start at the very end of the line and come on down this way.
That's a lot of pressure.
It's a lot of pressure. Okay.
I mean, there's
if you can't think of both, you can just think of one.
4 guys before me. They're going to take all the good things.
I think what hasn't gone well for crypto, I'll start there, is meaningful banking infrastructure to go hand in hand with a lot of the market participants. We've got a huge number of sophisticated clients who are used to trading, multi-asset strategies, and they just don't have efficient banking partners to do the sort of scale that they want to, which is really appalling considering the innovation that you see in other parts of the crypto space. And what's gone well, I mean, the general growth in institutional interest and looking at more derivative products off the back of the growth of spot volumes.
Thank you, Cameron.
For sure, I would just echo, for all those folks that work for banks out there, it's a massive problem for everyone across the globe, not just in Europe, for crypto businesses to obtain a banking relationship across the piece. So let's start on the negative side. Perhaps the rhetoric that we see, one, in the media, present company accepted, our friends at finance excluded, our friends at finance magnates, and also the rhetoric we hear in government. Bitcoin's boiling the ocean, Bitcoin's used by criminals, Bitcoin's the choice of ransomware. All these things are complete misnomers. And throughout the discussion, I'll give some examples as to why that is the case. I'm conscious this is a quick fire 2 minutes, so on the positive, to Cameron's point, adoption, not just institutional adoption. The last 12 months have been a wild ride. We've seen adoption both in the retail sector, also we've seen increased policy focus, we've seen total value locked in, or AUM, increase massively in many aspects of the industry, both in the centralized and decentralized space. We've seen adoption in terms of people coming from traditional finance, TradFi is what the industry uses, into the crypto space, and we've seen developments in the tech, layer one solutions, new blockchains, so-called ETH killers, Polkadot, Cosmos, Tezos, Solana, really solving some of the initial problems of the two main blockchains, Ethereum and Bitcoin, have had in terms of transactions, scalability, etc., etc.
Thank you, Ian.
So my take is that, you know, as was said before me, we're seeing institutional adoptions. We're seeing more adoption of the blockchain space now. Interactive brokers starting to offer crypto, and when we see more adoption of the industry and the recent trends with decentralized finance and NFTs and everything is adopted into the traditional economy, we will see more and more regulation. So the presumption that some of those projects may exist outside of the regulatory scope, I think it's not valid anymore. As more as this industry is moving into the traditional world and advancing, then we'll see more regulation and we'll see less patience for projects that do not adhere to regulations, because eventually when this industry goes, it can actually threaten the traditional economy. And we've seen recent publication by the IMF, we've seen recent publication by the SEC and other regulation, FCA. We're seeing, you know, in England, for example, we're saying that the FCA is more active and regulation is closing on crypto. So it goes hand in hand. You know, from one side, we need to be happy that, you know, there is an adoption of this technology, and this technology is definitely going to lead for the coming years. Then on the other side, as this technology is adopted and crypto is adopted more and more, then we see more regulation, and we see the need also for technology providers that provides more regulation and supervision over this space.
So I think that by far the most interesting trend of the last few years is the DeFi growth, the movement from centralized to decentralized. So say a couple of years ago, most people kept their money, their crypto on centralized exchange-based wallets, and they used to trade and keep their crypto there. Now everything is moving to decentralized. People are holding their money in their wallets, in their MetaMask or Trezor or whatever, trading, swapping on Uniswap or on Pancake. You mentioned other blockchains as well, and holding their money. Now, the benefit of it is that it gives them a lot of power, right? It gives them much more abilities. People can do staking, people can, you know, trade on different venues, cross from blockchain to blockchain, and so on. And that's all known. But the disadvantage and the negative outcomes of this is that with great power comes great responsibility, right? You're holding your money, and it means that if you send your money in error to the wrong wallet, then the money is lost, right? You can't call Binance or Coinbase and ask them for help. You can't use your lawyers or any other method that you can think of. Same goes for losing your wallet. Same goes for, you know, unfortunately passing away and not being able to leave the money to your loved ones. So I think that that's the main thing that is preventing mass adoption at the moment. And until that problem is solved, I think that we cannot expect our fathers, mothers, aunts to use crypto on a wide scale. And that also has to do a lot with the regulation, because people are prone to make mistakes, money is being lost, and eventually the regulator has to intervene.
Yeah, that's a really good point. We hear a lot about being your own bank, and being your own bank comes with a lot of responsibilities. If you lose your keys, you're done, you're toast. So I think that education part around taking that responsibility is an undertaking. I think just kind of to maybe summarize what everyone else has said, in the last kind of 12 to 18 months, I think what's been most powerful is the reduction of friction. From just across the piece. So going back to, layer one blockchains are now focusing on solving specific problems. So they are becoming a little bit more tailor-made. I think if we look at the last kind of big bull market run in 2018 and the whole ICO craze, that was all fueled by speculation. This bull market has really been fueled by removing a friction, by development, by building new products and services, DeFi, NFTs, all these things are new innovation. And so what I think is really exciting about that is to have a bull run that's spurred by speculation. Yes, number go up for a period of time, and that's great if you're on the right side of that. But what you're left with when the bear comes is nothing. And I think that what will be, because markets don't stay up forever, there will be a settling down of the market, and then what we'll have are actual products and services that people can continue to use and build upon, and things like those layer 2 solutions, so DeFi dApps, for example, that build on top of those blockchains, and different blockchains that enable bridges to other blockchains, is really making the ecosystem rich and wide with some depth around usability. I'll echo what everyone else has said in a slightly different vein. The downside to all of this is the regulatory scrutiny. I am very pro-regulation personally. The Chamber is also advocates for balanced rulemaking, but most importantly, we need clarity. So it is not enough to regulate by enforcement or to regulate by making things difficult, like making it so hard for a financial institution to bank a crypto company because they're terrified that they're going to face regulatory retribution. So the industry is asking for clear rules of the road and frameworks, and if regulators are going to place that scrutiny upon the industry, which they should, we just need them to come up with frameworks that everybody understands and can act against.
Right, exactly. I love what you were saying, Teana, about having an ecosystem. It used to be like Bitcoin to the moon, number go up. Then there was all these other derivatives of that. But now it's much more about actual products, services, things that people need, things that meet human needs, that meet human interests. And yet, as many of you pointed out, there's still this narrative, I think, among many regulators and also in media and some other places, that crypto is dangerous, it's illegal, Bitcoin is for criminals, blah, blah, blah. I'm curious what all of your thoughts are on where these two narratives meet. So we've got the growth of this ecosystem on the one hand, and on the other hand, we've got still this sort of resounding echoes of, this is all bad and criminal. Do you think that that's changing at all?
Can I
Sure.
just sort of state one thing we see in the community, and it's an interesting piece of friction, because on the one hand you have the ethos and philosophy of decentralization. We don't trust governments, we don't trust the financial institutions. This is what the original Bitcoin white paper proposes, pure peer-to-peer payments network that's completely trustless. And now we see adoption got to the point where governments are looking at it, and what do we want as an industry? Do we want to remain outside of the regulatory perimeter? Well, that's kind of impossible unless you fly to the moon and set up your business. Even in decentral land, there is always starts as a central entity, there's VC money generally, and there's people that are in the public domain. So you cannot escape this. If we want adoption as an industry, then we have to work with policymakers, because at the end of the day, the ethos of regulation is to protect consumer harms, protect against illicit finance, and to make sure we have financial stability and market environments that function effectively for everyone.
Yeah, I agree with everything there, but I do think that there's a general theme running in crypto, which is we want regulation, but it can't stifle innovation, and we absolutely need to make sure that I mean, if anyone who's familiar with traditional financial markets, what a MiFID II or Basel III directive would look like for crypto would put half the companies currently running a business out of business because of onerous, regulatory reporting, et cetera, et cetera. So it needs to be, they need to get the balance right, because crypto is still a cottage industry, and you're in danger, I think, of ruining some of the fantastic work that people are doing because they don't currently have the onerous reporting standards that they might have to adhere to. And it costs a hell of a lot,
I think we have a communication problem, going back to your initial, what is spurring this. So both of those things, to me, the industry is not very good at communicating both to the wider community and to regulators. Okay. So we say, and I've heard people like Commissioner Peirce say, be careful what you wish for. You're saying that you want us to regulate you, and, it'll take 100 years to undo something that we do. So be sure that this is what you want. And so we don't communicate the values, the benefits, and our understanding of the risk and what we're doing to mitigate that risk consistently and coherently to policymakers. Right. And as an industry, we kind of sit back and say, oh, well, we want to be regulated. We're happy to be regulated. But also, we don't come up with solutions. What would that look like, right? And so it's really important, I think, to help policymakers not only understand the technology, the benefits, and the risks, but what would it look like, instead of having a MiFID-like structure, how could we potentially put in place something like a safe harbor, for example, gives issuers 3 years to innovate, decentralize, build the product, and get a network in place, and then evaluate and be able to exit that safe harbor. Or sandboxes are another example of that. So the communication problem, I think, is coming from the industry, and it's the same with press, and it's the same with organizations like Fatf or the IMF. If we're not able to advocate for ourselves consistently and coherently and sing from the same song sheet, because it'll differ by jurisdiction, it'll differ by DeFi. Well, you can't regulate us the same way that you regulate, CFI, or you can't regulate us the same way that you would regulate them, or we're serving institutionals, so we need this, and it's different than that. And it just confuses regulators, and it confuses the press, and this is where you get some of this information brewing, I think.
Right. Yeah.
You also need to be honest. I think that's something which is missing in the industry. Being honest with ourselves. If I'm running a DeFi project, or DeFi, but I'm actually controlling it, then it's not a DeFi. So many of the projects which I've seen, in this industry are a bit confused about what is DeFi. If you have a project that is not decentralized in the top, okay, and the admin keys and everything is controlled by, a group of people, then it's actually, you're running a financial institution, you're providing financial services, you need to be honest with yourself, and you need to be honest with the regulator. When you come to speak with the regulator, this is not a DeFi. And actually, there's no, you can't start with with a project which is completely decentralized. It's something that progresses over time. This is why the safe harbor that was mentioned before is a really good solution, which was suggested by Commissioner Peirce. Doing a safe harbor, giving a period of time to become decentralized, and then delegated the project into a decentralized autonomous organization, a DAO, that controls the different aspects of running the DeFi project. I think it's a good idea. But then we need to decide again, what is a true DeFi, or what is something which is pretending to be decentralized. So starting with being honest with yourself, and then being honest with the regulator would be a good start.
Yeah,
I agree with Ziv on that one. I think that there's a contradiction between the pace of things, you mentioned it, between the pace of the development of the technology and all those new solutions. I mean, smart contracts, they allow you to do anything. Me and Ziv were lawyers. It's going to run us unemployed eventually, right? Because you can do so many things with smart contracts. You can program so many different aspects that I've spoken to several people here that are involved in more traditional finance. So many things that you can program that you can allow people to be certain about. But then again, how do you regulate it, right? How do you regulate something that is decentralized? How do you do KYC when all I know about you is your wallet, and I don't know anything about you. I'm not even allowed to collect any information about you. And also, we have to look at the market. The type of people, I'm generalizing, but the type of people that are using crypto and DeFi in specific are people who do not want to be exposed. So
I don't think that's true.
Really?
No, I think that's, again, another misnomer. I mean, in my experience, that is not true, that people don't want to be known. I think that there is always going to be a cohort of people that value their privacy, for sure. And there is always going to be kind of the original, OG cohort of crypto anarchists that, going back to the Bitcoin white paper, wanted, sovereignty, privacy, decentralization, for sure. And some of that comes with, maybe being less willing to be, visible. But I would say that you cannot grow at the rate that we've grown to, trillions of dollars, and the rate of, even retail growth on trading platforms anonymously. It's just not possible. And if you look at the volumes going through regulated KYC platforms versus unregulated KYC, or decentralized exchanges, I mean, it's just paltry. It's nothing. So I push back on that.
I have to say, I haven't finished, but I would like to say that I do agree with you that there needs to be some sort of a KYC process. I'm saying that it's maybe the traditional way of doing things. Let's say the way that the FX companies are doing it. Maybe it's not really suitable for that.
Agree.
And there are a lot of creative solutions. Take Coin Intelligence, for instance. Okay, they're offering a very viable way to see if the transaction that you're receiving comes from a bad source of money laundering or terrorism or whatever. So you have so many solutions, again, that are based on technology that are not your traditional hammer by the regulator. So I think that I do agree with you that the industry itself has to be creative and has to take initiative and has to think how we can prevent the bad things from happening and how we can prevent the wrong sides of anonymity. And that in turn will definitely calm the regulators, or at least we hope so.
100%. And I think that, I've been on the other side of that table saying to regulators that cookie cutter, cutting and pasting the existing ways that we prevent money laundering and counter-terrorist financing today are draconian in some cases and or not fit for purpose, and to be honest with you, don't really prevent a lot of money laundering today. We catch like 1% of money laundering in today's fiat market with the existing programs we have in place. So they're not very effective. So why would we put it onto this new technology? However, when you say, but there's a way that we could, provide identification or tokenized KYC or, transaction reporting or transaction monitoring in this new innovative way using this technology so that we wouldn't have to use these old methods of reporting, storing data, transferring data, having honeypots of data for people to hack into. And then they say, great, brilliant. How would you do that? Silence from the industry, right? So the thing is, absolutely, we could do that, but building those things, and I think you'll agree with me, not sexy. So people don't necessarily, and not like, if you're going to spend time to build something, you want to spend time to build something where you're going to make a shit ton of money. And this is probably not that, but it would be critically important. If I could code, that's what I would build.
I hear you totally, and I think we're touching on another very interesting and important paradigm here, which is the balance between anonymity, privacy, and surveillance and regulation. So somehow those four things here, that right now decentralization and decentralized platforms are attractive to people who want to protect their privacy, and also sort of greater in the media and the world narrative right now is this topic of privacy, especially as when it comes to all these centralized platforms, for example, Facebook, which was down, 3 hours the other day. So a lot of what I've heard, and maybe Teana, you can speak to this, and all of you, coming from people who are advocating for crypto is saying that, hey, regulators, actually you can use this to keep even better track of money, and you can use this to keep even better track of people's identities and what they're doing. However, there's a risk there, right? Which is that if we sort of create the keys to track all of the money in the world and all of people's purchases and everything that they do, you know, where is the balance there? And you know, how can we build those structures in a way that doesn't lead to total centralized control? What do you think?
Well, I'll tell you two things. The first thing, I'll try and be really brief, that scares the bejesus out of me, and it is not crypto. I want to say that again. Not crypto. CBDCs are not crypto. They are not stablecoins. They are not cryptographically, tokenized assets. But it is tokenized fiat, or it will be, digital fiat, not too dissimilar to what we have today. But if CBDCs become the, mass adopted, there's an awful lot of information about you that's going to go with every single transaction that you make. And I don't believe that people who value their privacy are doing something illegal. There's a big difference between, valuing your privacy and trying to be anonymous because you're conducting illicit activity. Huge, huge, huge difference. So I'm worried about that. From a track and trace, I think one of the things that I try to, currently ransomware is a huge, huge topic for regulators all around the world. And there is this narrative that cryptocurrency is fueling or increasing the prevalence of these ransomware attacks. Now, if we're honest as an industry, I think we have to admit that cryptocurrency is a very effective payment mechanism, especially if you don't want to be known, right? Yeah. And you want it to be fast. So if you look at the timeline of ransomware, ransomware is not new. Ransomware, the first ransomware attack happened, something like 1998. So there's been decades of ransomware. And the methods, wire transfers, cash behind the dumpster, gift cards, crypto is much more efficient than that. But the beauty of crypto is, go ahead and use it, especially Bitcoin. And the Bitcoin ransomware demand is something like, I'm going to get this number slightly wrong, but it's like 89% of all of the ransomware payments demanded are in Bitcoin. Bitcoin is stunning for the ability to track and trace, and in many cases, and in most cases, recover. So just look at the colonial pipeline. So the big thing here is, what's actually driving this? A dependency on technology and an absolute, utter lack of appropriate cyber security. If your cyber security is not appropriate, you're going to get hacked. And if you look at Colonial Pipeline, the way that those hackers got in was a lack of 2FA. It was just as simple as that. So the crypto community needs to be a partner to law enforcement, and ideally, it would be great if there was some disclosure requirements so that big companies who get a ransomware demand then kind of have to report it to somebody, because right now they don't have to. And then the crypto community can be prepared to track, to be aware that those transactions are going to come into their environment and do something about it.
Absolutely.
I have to say, my company deal with CBDC, and
not crypto.
My co-founder, it's not crypto. Yeah, I agree with this. My co-founder is the former director of currency of the State of Israel, and we deal with CBDC. We're working with the Bank of Israel on it. I do not agree with the premise that it's not. It's something that can threaten the privacy. I see a social benefit for CBDC. I see a social benefit for an economy which is more transparent, where you can see how money flows in generally between the different pillars of the society. I see a real social benefit of CBDC, and I think that the fact that we think today that what we do is not transparent, when we're transacting with our bank account or with our credit cards and so on, and it's all private, then we need to think again. That's and CBDC won't change it for good or for better or for worse. I think that the evolution of CBDC will take a lot of intermediaries out of the market that are stealing our money, those credit institutions and so on, and it could actually create a lot of prosper.
Oh, I totally agree with all of that. Completely. I just have some issues around the privacy.
Can I just speak to the privacy and let folks know, if they don't already, some of the technical solutions the industry is working on? So right now in the UK, there's a public consultation for the travel rule, which is to do with Financial Action Task Force, crypto businesses, FASPs, will have to send beneficiary information and receiver information, just like the financial markets, right? This is the same type of legislation. And so what we are talking to Treasury about, Her Majesty's Treasury, is there is an opportunity here to use the technology, and there's a group in the US called TRISA, which are developing zero-knowledge proofs to be able to bake in private personal data to each transaction. And we talk about personal data within the token, baked into token. These are developments that are happening. There's some very smart people in cryptography that are coming out of academia, working specifically in the crypto industry. And to talk about CBDCs, it's a very, again, interesting debate. And we've seen what China have done, and we can argue that's just about surveillance. That doesn't really improve the digital payments infrastructure. In the UK and Europe, we have SEPA and the faster payment system. These systems aren't broken. I don't want to say the word, but I'm going to Facebook. It makes me shudder. Thanks to them, central banks have started looking at public stable coins, which is what a CBDC is because of Facebook's DM, previously it was called Libra. The problem that central banks have is protecting privacy data, and those that understand or well aware of the history of Bitcoin and decentralized payment networks, one of the original cypherpunks, David Hume, who proposed an electronic payment system some 20 years ago, he wrote a paper with the Swiss National Bank that solves the problem of privacy for central bank digital currencies. There's some really good academic work out there. CBDCs do have a positive use case. They can improve the retail sector and they can improve the wholesale banking sector, but there's a lot of problems around disintermediation and the fear of the banks not being able to lend because the credit dries up within that space. But I do think we'll see a future where more digital related payments, whether it's a CBDC or something else, does permeate into society.
I have to agree with Ian. I think that the main contribution of the CBDC, at least from my perspective, is the fact that so many people who are not interacting now with crypto, and I agree it's not crypto completely, maybe more than anyone else I would agree here about that fact. But still, the fact that people will start holding wallets, interacting with that money, we see what's going on now in El Salvador, right? It's a slightly different thing, but still, we see how people are starting to understand and to figure out what crypto means, for good and for worse. And I think that definitely the entrance of CBDC, I'm not sure about the Chinese version, but definitely for instance, the UK-based version or the Israeli version is very interesting, and it might push us closer to mass adoption.
I think there's an interesting arms race happening in that regard as well, because if you're Chinese and you have central bank issued digital currency and they can put a time and expiration on it, that central bank has a separate lever at their disposal to control the economy. You look at the problems that dollar debasement and interest rate suppression has created in this environment. You now have a rival central bank that has a separate outlet to force people to spend, which completely changes the dynamic, and does that then leave other central banks at a disadvantage? And are they strategically, in a situation where they have to follow suit because they don't have those options available?
Yeah, Michael, I think that back in the finance magnates days, we actually may have written about this topic a little bit, that it's sort of like a, cryptocurrency war, if you will, that, if China, for example, or the United States or whoever has a CBDC and they say, hey, we'll give you a discount on, this shipment or whatever if you pay with the CBDC, do they have that advantage? What do you guys think about that?
I think for me, if you look at the institutional space, there's the benefits for the Western central banks to start thinking about baking in monetary policy. So you can faster react to macroeconomic changes by implementing an interest rate change pretty much immediately. Currently in the UK, there's a 2-week lag. The markets react to it, markets expect it, and prices in the derivatives market sort of expect that and react quickly. But for the underlying lending and borrowing market, there's always a lag. So that's a benefit. But there clearly is an arms race, to Cameron's point, because we've seen a massive proliferation of research papers, working groups. There's a task force in the UK. The ECB are talking regularly about electronic payments and digital payments and CBDCs. So, yeah, people are scared of China, second largest economy in the world, and they're not necessarily as they're more opaque than other Western governments, so other governments in the globe. So yes.
I think that indeed there's an arms race, as you mentioned. I don't want to go too deep into global geopolitics and so on, but there's a certain framework that within this framework, because of many reasons, the dollar is still the king, right? And the Chinese are trying to break that framework, and in the traditional way, they can't really do that. Now, with the CBDC, that allows them, at least they have a path towards doing that. Imagine if every e-commerce that all of us are purchasing from China will have to be paid in their CBDC. Every commodity that is being bought in Africa or in Asia or in Europe that is coming from China will have to be bought and paid in CBDC. That can change the picture totally.
I can tell you what's happening right now is like everybody's having like this plan in the drawer. Like they're expecting if something happen, we'll have this plan for CBDC. And everybody acknowledged the arms race that's going on. By the way, it's not clear that CBDC is much better than the current payment system. You know, there's like we're speaking with the Bank of Israel all the time, and we're speaking to BIS, Bank of International Settlement. Recently, Danny Layden from Corda, we moved there, and we're speaking, and they're not really clear. You know, there's some countries there's not enough cash, and they're starting to introduce CBDC there. Other countries has other idea, but eventually it's about the currency world. You know, eventually it's what's been said here before. By the way, I really connect to what you said before. Like we're speaking to the Bank of Israel, they all have their MetaMasks. You know, they're all transacting Ether between one another, the technical guys. It's cool, you know, they understand what crypto is. And, you know, I don't know if CBDC is going, you know, to happen in the, next year or two, but definitely, like, in terms of adoption of the technology, it's done us a lot of service.
And I'd like to go back to something that we've touched on earlier, and I think, Teana, you mentioned this trend, of ecosystem development, but also consumerization of products across the board, removing friction from the process of buying crypto, storing crypto, et cetera. And I'm curious if that trend, from your perspectives, has sort of helped regulators maybe become a little bit more friendly or open to the idea of crypto, just that they themselves can experience crypto a little bit more easily. And, as the Chamber of Digital Commerce, for example, had this program, I believe, where they were sending something like $50 worth of Bitcoin to every senator, was it? And that, these regulators could just say, oh, I have some Bitcoin now, and, I can experiment it with and use it. And it's not just this thing that exists in the world. And I think that this is also an important, when it comes to retail versus institutional regulations, as you were saying, that there's sort of one set of regulations that should apply to DeFi, and one that should apply to institutionals, and one that should apply to retail platforms. What are your thoughts on the effects of consumerization for regulators?
So, yes, I think a lot of it is just getting them familiar with it, and I agree with you. I think CBDs, I think of them as kind of a regulator gateway drug, right? So, you get them comfortable with CBDCs and they're playing around with wallets, et cetera. Yes, that definitely happens. The other thing is, as regulators are, in some cases, being forced to undertake some kind of oversight action. So we'll use the UK for an example. The FCA has been very hesitant to regulate crypto assets, taking this wait-and-see approach, which is not helpful for the industry. And then AML D5 came out, and so they were forced to do something. And so they put in place this AML regime, which meant that all of the crypto asset firms had to apply to continue to operate. So within that process, they're reading through business plans, and I was a market participant at this time, so I've applied for this license 3 times now.
Any success?
Not yet. They are having to download the app, open a wallet, make a transaction, because it's completely impossible to evaluate someone's business model and someone's business plan unless you understand exactly how this works and exactly how this happens. And so what's happening is the conversations we're having with regulators now are much more informed, not necessarily technically, but what does the customer see? And so if we're going to focus on consumer harms, which is, you know, the role of the regulator to prevent that, and then more broadly market stability, but really it's around the consumer. What do they see? Are the prices clear? Are the fees noted? All of the kind of business model around them, what they have access to, what they don't have access to, how much information we take from them, at what time, what do we know about those customers, et cetera, right? Just like you would with a bank. Yeah. So I think what is clear, though, and I'll stick with the FCA, they've now put out, I think this is the third year, their kind of consumer survey, and they kind of, I mean, you can see it in what they publish. They're shocked every year that crypto keeps growing. And in the last report, it was like, well, we can't believe that there's another like 1.7 million crypto users in the UK year on year from 2019. And that's not a shock to us commercially because we see those volumes growing. Right. And all those people can't be concerned about privacy. They're not all crypto punks, right? They're just average people. And the thing that I would love to kind of push out there is it isn't, I mean, it is technical. Crypto assets are technical. But if you focus in on things that you care about, going back to your ecosystem question, if you care about, you know, data and healthcare, if you care about financial inclusion, if you care about, you know, emerging market remittances, you think they're too expensive, if there are like social issues that you care about, there's almost always some project that is working on solving that problem. And dive deep into those. Don't just follow the market. And I've said this 1,000 times, I'll say it again. The price is the least interesting thing about the crypto market.
To, if I may speak to our audience of FX professionals, in a previous life, I traded FX and fixed income and a number of other products. What we hear a lot from the institutional community, especially on the buy side, FX desks want access to crypto. How do they get it over the line with compliance? What's the liquidity? You know, where's the compliant liquidity? Where do we get that from? Where's the infrastructure? Can I cross margin? Where's the provenance of the tokens? Again, that's a compliant liquidity. These are the questions we hear. Well, and also custody. I think we've heard about custody being an issue during this event. Custody, for me, has been solved. We have Fidelity. We have Standard Chartered. We have Northern Trust, all regulated entities providing crypto asset custody. It's fundamentally different to store digital assets as it is to regular securities. For me, that's solved. Compliant liquidity is being solved because of EU AMLD5, as Teana mentioned, and a financial action task force. The infrastructure isn't there in the institutional space, such as consistency around documents. You can imagine that, you know, using ISDA is freely available. We take that for granted. There's none of that. ISINs are being developed for crypto assets right now, so that will be solved. But in the decentralized space and for the native crypto businesses, such as the Coinbase, the Binance, this market infrastructure is available. It's just a heavy lift for the financial institutions to partner with these organizations for the reasons I just mentioned. So it's a work in progress.
I can echo a lot of that. You know, we actually trade with a lot of our clients under ISDA, which has been, you know, part of the sort of the professionalizing of the products to the institutional space. What's interesting is the rise of the quality of third-party screening tools makes it very, very difficult to ignore the fact that people can have appropriate compliance monitoring at the click of literally the click of a button, and they pay a monthly fee, and the quality in blockchain monitoring is uniform across everyone, which means you have at least some kind of base level playing field that you can evidence to the regulator. And that's what they really want to see is, do you have systems and controls in place? Can you evidence them? Can you give us examples where you've done blockchain monitoring and it's led to X and you've shown it to the client, etc. You know, and that is paramount for them, because ultimately they don't want to have to regulate the institutions. They want to protect retail, but they need to be seen to be shepherding the institutions towards, you know, bigger uptake. And the thing is, the institutions, they don't want to trade spot initially, the bigger guys. They don't want to custody it. It's a, you know, an accounting problem for them. They have to, get all sorts of risk committees to agree, and board level, at an ideological level, there's still lots of decision makers in these companies that don't want to be trading crypto. So the next level down is what looks and feels like an existing product that we're used to trading. A lot of the banks are now looking at NDFs, emerging market FX type NDFs. They can slot it into an existing desk. They have legacy infrastructure that allows them to trade it. And it's actually, I say seamless, relatively seamless. So it might take the banks 2 years to do.
An easier lift.
Yeah, and that's optimistic. But it shows that the intent is there. And it's not even the banks that are driving this, it's their underlying clients. They want price exposure, and they want it as quickly as possible, and they want it from an existing prime broker that will be able to offer that to them.
Great.
We just have about 1 minute left. We can take some questions from the audience. Yes, we have some. Great. Okay. Microphone is coming. Yes.
Hi there. Thanks for the great panel. Question for Ian and maybe Teana, if you want to jump in as well. What do you think are the long-term implications of the FATF travel rule on self-custody wallets? And I can elaborate on that if you want. Right now, for those who don't know, Ian mentioned the FATF travel is making exchanges they have to share the KYC data of the person depositing or withdrawing with another exchange. So effectively, the governments see that as like a bank transaction being transferred between one exchange to another. And do you think that they see someone depositing like one Bitcoin from a self-custody wallet to an exchange, the equivalent of someone walking into a bank and giving them £50,000 in cash?
It's a very good question. It's something that the industry has really advocated hard not to bring in self-hosted or non-custodial wallets into the travel rule at this stage. It's really, really difficult for centralized businesses, FASPs, to solve for the travel rule. And we recently, CryptoUK, ran a working group with our members directly at Treasury to tell them this. What are the solutions? Are there any products out there? There's a few of our members that do provide certain solutions, but there's no fixed standard yet. And it's fundamentally different when you send a payment on-chain. How do you reject it if it's not compliant? How do you even know where it came from? So this is what we're trying to work through. And the direction of travel is this is coming. But to your point, the Fatf issued this guidance in March. They released the updated result of this guidance in the summer. And because they received so much, I wouldn't say pushback, but information from the private sector regarding the problem around self-hosted wallets being treated the same as centralized wallets, that they delayed this guidance. I'd be interested to see what happens in October. But my personal view is, and most people in the community that we speak with, it's far too soon to solve this. One would expect in time that our friends at MetaMask and other wallets out there's plenty out there, not just MetaMask, will start thinking about this, and I'm sure they are, and there will be a world, but not for me, not in the short to medium term. This is a 5-year horizon to solve this issue. But you can argue that policymakers are scared because you can onboard on any platform, Uniswap, SushiSwap, in the NFT space, and you could launder money pretty easily if that's your inclination, but that's a very small percentage, as I think we said. Teana, you have some comments.
Ian. I would encourage you to actually go to Fatf's website, so the guidance.
I'm on the Trader working group.
Yeah. So. Oh, okay. So if you look, the guidance that came out in June has been refreshed very recently, and previously they had said that unhosted wallets were riskier. They conducted a deep dive with Chainalysis in August, and they've refreshed that statement, and they've removed that. Actually, it's now gone, that unhosted wallets are riskier. I would expect that we're going to see a softer treatment come November based on conversations that I've had directly with the working group, whatever they're calling that.
God, we hope so. Right.
Also, I think from a DeFi perspective, we've seen them kind of take a bit of a pause, understanding that this issue directly will relate to any treatment that they put on top of DeFi platforms. So if you remember going back to January, the statement was, there's no such thing as DeFi. If a service is being offered, someone is offering it. And again, I think they're starting to understand that that's quite nuanced.
Thank you, guys.
Any more questions? Yes, right here.
Hello, thanks very much for a really interesting panel. It's Tom Higgins from Goldeye. There are hundreds and hundreds of crypto exchanges around the world of very varying quality and legitimacy. I just wonder what the panel thinks, how that will play out over the next year or so as to whether they'll continue or whether there's going to be some consolidation there and where it's going to go.
I think it will end badly, quite simply.
Street fight.
Well, I mean, yeah, you have a number. The red flags have been raised, right? You have some of these exchanges who are actively closing down offices in certain jurisdictions. You know, because if you think you're going to get raided, you can't be raided if there isn't a door. You know,
True.
so
True.
The warning shots have been fired. You know, unregulated, non-domiciled, a lot of them, unfortunately, Chinese-based exchanges. Are becoming more and more problematic. They're becoming political as well. You know, let's be honest. Ultimately, the US wants to champion the Coinbases of the world, really push people towards trading futures on the CME. And for a lot of those other exchanges, they're competing in and around that. The lack of globalized regulation obviously makes it more problematic. But the quality of the KYC at some of these places is purposefully bad because they know who their clients are. Actually, you know, they understand that what sort of clients are that are using all of these venues. So I would say in the next 6 to 18 months, you could probably expect 2 to 3 of the top 20 exchanges by volume probably no longer being around.
And we've seen that with big exchanges. So big market players receiving some kind of regulatory slap in one jurisdiction and then literally a domino effect across their entire portfolio. And so what happens then is it spooks consumers, right? And they kind of flee to what they consider to be, you know, safe, regulated exchanges. And people are creatures of habit, so moving all around. If you're, you know, you're kind of your home exchange who you typically go to first, right? But the other thing is, I think that liquidity follows liquidity, right? So on the consolidation piece, I think we're due for that anyway. And as more regulatory regimes are rolled out and more venues are able to actually become regulated, that liquidity is going to centralize because the institutional players or, you know, the semi-institutional players, hedge funds, et cetera, that's where they're going to go because they don't want to have the risk that someone's going to get knocked on the door and shut down. Or more importantly, the challenge for retail is the fiat on and off ramps get shut off. So you might still be able to get on that exchange, but if you want to off ramp into fiat, no hope.
Do you think the traditional exchanges might just end up buying them all like they're buying everything else?
Traditional exchanges like SDX
CME,
or LSEG or something?
CME, NASDAQ,
I don't think they can afford them. You know, the valuations on these exchanges are absolutely eye-watering. You know, there's no business case.
And they don't know how to run them.
Yeah.
It's not the same business.
Oh, wait. Oh, sorry, Michael. Yeah, go ahead.
No, just a short remark. I think that we will see consolidation. I mean, CZ, the CEO of Binance, he said that he invests 90% of his time in regulation, and a couple of months ago, and as he should. And not everyone is able to do that, right? Binance has a lot of money. Binance can allow themselves to regroup and to change their ways now and to offer KYC and so on. But the smaller exchanges probably cannot do that. So I think that we'll see 2 tiers of exchanges. The bigger ones that want to be more regulated and more cautious, they will remain and maybe even grow. And the smaller ones will just fade away. Plus, add to that the fact that, as I said, so much money is moving into the decentralized exchanges. Then you see a trend here that causes, it's a tide that allows only the big ships to rise.
I think we should, you know, a trend that I'm seeing that is starting is a combination between regulated DeFi. So the protocol is decentralized and does all the functions of automatic market making and so on. But then if you want to on-ramp and off-ramp that protocol, which is a fork of the original protocol, which is decentralized and open to everybody, then you need to go through a gateway that you need to go to KYC and so on. So you know, getting all the benefits of the DeFi world, which is very efficient and, you know, with not a lot of intermediaries in the middle, but also having it regulated. And we've seen Baffin approve such a project recently, and I know of other projects in other places in the world, and actually, like, the amount of apps that can connect to such an exchange and other applications that connect to such an exchange is amazing. This is going to change the world.
Absolutely. I wish we had more time to keep talking, but unfortunately we are all out. Please give a round of applause to our panelists. Thank you all so much.